question here. We had a question also we had also here a question on part 2, question 2, question 2, which is a very simple question. The question is, in cash flows and dividend-based valuation methods, cash flows and dividends are discounted with different rates. That's what we saw yesterday evening. With these models integrating future flows, and you have basically 2 categories of models. The first one based on cash flows. It could be different kind of cash flows. Even if most of cases it is a free cash flow, as I explained in one of my slides during the last course. Okay, and the second one is mainly based on dividend. Okay, but when you make the calculation on cash flows, you use, as you know, as you have ever done since the course on investment decision, we use the weighted average cost of capital. So the question after that, I will come back on this one, is how to calculate the WACC. What do we have to integrate into the WACC? And in the second case, it is the shareholders approach which is adopted. It means it is a discount rate, which is the cost of equity. This is what we have. So you have to explain that clearly, but you know how to do it. There's a question again I want to go through with you, which is part 4, question 1. You see that? Part 4, question 1, still the same exam, November 2021. Part 4 is a question on the cost of equity. It's a question on the cost of equity, which is quite simple, many things now. And in fact, we have 2 questions, and you have to deal with the 2 questions. But here we are mainly interested in one of them. Second one, we'll deal with this question later. Question 1 is very simple. The cost of equity of a firm can be estimated using the Gordon-Shapiro model. Okay, explain and discuss the results obtained and their quality. So you should explain that the Gordon-Shapiro model in the basic format is very difficult to manage because we have these numbers and the forecast up to year 10 or 20 or 30 infinity somehow. But we are lucky enough, if we can apply what we call the convergence rule and terminal value, it means to reduce, in fact, the formula to something much more simple, which is P equal to D divided by K minus G. Remember what we did yesterday, of course. And in that case, we can calculate K in the model, which is a cost of equity, if we have a good knowledge of the 3 other elements. D, the next dividend, generally you know it, or at least we have a good proxy. The price is, it means the value of the company. It could be easy if a firm is listed. It's another problem is a firm is not listed. You have to find the price and the value of the company before using the method here to calculate the cost of equity. And you need G, and G is the long-term growth rate of a dividend, and this long-term growth rate of a dividend can be obtained using a regression method. It is the slope of a regression I explained yesterday night. Okay, so that's how it works. First argument, we need to be in a case we can use the simplified formula, P equal D divided by K minus G. The hypothesis is that K, the cost of equity, should be higher than G, the long-term growth rates of the dividends. The second point is that, of course, we need to have a good proxies of 3 out of 4 of the elements which are used in the calculation. In that case, if we are looking for K, it means we need P, D, and G. D, generally easy. We have a good knowledge, good proxies. It's very short term. P, it depends if a firm is listed or not. If it is listed, it's easy. If it's not, we have to calculate P and the value by another method. Okay. And G, it's exactly what we did yesterday night. You use the past and the expected dividends, and you apply a regression method of that, and you calculate the slope, and you check the quality, studying the variance and the sum of the distance of the points of the graph to the straight line of a regression. That's what you should answer. Yeah, and that's what I wanted to show you today in terms of answers on one of the preceding exam. It is the last one I gave on that course. Okay. So that's it for the examples, and I come back, and I hope it will work. I come back here on the slide which are called MEBF 17 session 2. We went through 2 and 3. I moved to the November 2021 exam in order we deal with some questions which are application of what we did yesterday. And now I just want to move to the next slide. And the next one is about biotechnology. You will have to deal with biotechnology. You get biotechnology and not ready to send you another version. If you lose your version, ask Mrs. Twilin or Mrs. Tram for to send you back the case. But the problem here is to try to find the value for biotechnology. And I already said yesterday, a lot of information are available there. You have a past balance sheet, a past income statement in 3 years. You have sufficient elements to design a financial plan, what you did already, to estimate the financial resources available, all financial needs. That's within that. You have necessary element to measure the potential returns, the level of risk, and the debt capacity. And you did that also. So now the problem which is raised here to say, okay, we have to go further into the application of the architecture, okay? But also we need for an IPO, for a potential IPO, to find a potential price. And first we have to make calculation of different values before moving to the elements, to the pros and cons for on the state of the market and on the behavior of a shareholder. So of course you will try to apply what I already mentioned, And the first thing you have to do is to have a look to the book value here. And at the time of the operation, of the analysis, evaluation, you get enough elements, to find easily the book value of a company. You can argue also on the potential increase or decrease in the future, it means on the next 5 years, of the total equity level, which is can calculate using the balance sheet. Second, you will have to use future flows, and you know that we have two hypotheses. It means if we have two analyses, you will have two different analyses with the two scenarios, hypothesis one, hypothesis two, and you can have a proxy of the value of a company using a cash flow approach. You need the WACC, of course, but to calculate the WACC, you need the average cost of debt, which is quite easy to calculate here. And you need also the cost of equity, but you have the possibility to calculate the cost of equity using the capital asset pricing model. After that, it's problem of weight, and you have the weight of the two elements in the balance sheet. So this is also possible. Now, it's a bit more difficult for the Gordon-Shapiro model, because you will, when you will analyze dividend policy, and you did that already, you understand that it's not stabilized. It's a kind of opportunistic dividend policy, which is defined year after year. And if you apply the Gordon-Shapiro model on the past, which is not really how to use the Gordon-Shapiro model, we will see that it is difficult to find, for example, a regression line with a good quality. The different points are far from the regression line. The variance quality is low. So what you should do, of course, is to define a policy, a dividend policy for the future, taking into account the level of the cash flows and how the cash flows could be split between the different use, and what is the part given to the shareholders. After that, you will be able to come back to the Gordon-Shapiro in a classical way. A discussion, which is point 3 here, on the feasibility of the different values and the different calculation could be very useful in that case. And of course, you will find that some of them, multiples, cash flow methods, have better quality in terms of value proxies than the others. With these elements, we have to go from values, the different values you find, to one price, taking into account the relative quality of the values obtained, taking into account also the evolution of the market, financial environment, I would say, of some elements, and also the behavior of the shareholders. And you know that the behavior here of the shareholder is very positive because of the return they can obtain, the increase in this return, which is regular, but also the fact you have potential investors here which are ready to bring their financial resources. So that's what you should do. In order that you go further into the calculation, I will send you probably tomorrow, a few more data in order to go further into the analysis. One or two more points on that. When you deal with the capital asset pricing model here, remember that you have a table which is Exhibit 2 with the 10-year government bonds and others, but you know, the tradition, it's a tradition more than anything else, is that the risk-free rate is generally, the 10-year government bonds, most of the works we use for infinite bond, and you get this number into the table. So don't find too complex element. But this is at the time, of course, of the calculations. And one of the key points here is also what will happen in the 2 or 3 years to come. The 10-year infinite bond interest rate will go up or down by 20%, for example, which is always possible. What will happen? What could be the consequences? This is one of the issues I will raise in my points in my question. You have also in this formula the expected return of the market, and this is given also in that case. But what happened, if has it happened for the last 2-3 years? We have a decrease and then a decrease by more than 30%. What are the consequences of that? Okay. So I will bring you some more elements like that in order that you make a kind of analysis of the consequences of some modifications, some hypotheses and the parameters, and you can argue on the stability of the values and the price which is obtained. So that's a few more words here. Now let's move to the next slide. Yeah. Let's move to the next slide, and the next slide is more on leasing contract. We are very clear on leasing contract. And we do the same for the different kind of shares. In fact, if you want to make a short presentation here, you should remember that we have equity, ordinary shares, I would say, and on the other side, the other extreme of long-term financial resources, we have long and medium-term straight debt. And as long as we are in that kind of situation, it's quite easy to calculate the cost of debt, cost of equity, and weighted averages. And you can add, as we did, the fact that the firm is profitable or not, and there is an impact or not on the tax rate. But we have also other elements to take into account, which are all these financial resources, which are somewhere between ordinary shares and straight debt. If you try to identify some of them, what can we say? We have other categories of shares. We don't have only ordinary shares, but we have what we call preferred shares, which are shares mainly, but shares with some other characteristics, without any right of vote, with a double right of vote, for example, sometimes multiple right of votes, shares with higher dividend than the ordinary shares, and it can be at the same time without a right of vote, but in compensation, a higher dividend than the ordinary shares. So you understand that we have another, it's a category of shares which are not the ordinary shares, but inside this category, we have multiple cases to take into account. And of course, these specific shares, they bring some new elements in all our classical calculation. It could be what to do, how do you integrate that in a debt equity ratio? What is the impact of the return of shareholders? What is the impact also on the value of the company? So after this category of preferred shares, we have, I would say, debt with specificities. And that with specificities, and we'll come back on that, they are not straight debt with fixed interest rates. They are debts, but they can be with variable, flexible interest rate. They can, as you know, be with different structure, annual equal repayment, infinite structure, for example, zero coupon structure. But they are still, I would say, debt, of course, even if we have different categories of structure, of determination of the interest rate. But of course, their cost and the risk level is not exactly the same as a classical straight debt infinite as a reference for risk-free rate. So we have several categories of debt, and this debt, for example, can be more specific. If I'm still in this category, the interest to be paid can be with a cap or floor. It means a minimum or maximum, whatever are the circumstances or the indexes used to fix, to determine this interest rate. Okay, so that's the second element on the other side. Straight debt is the basis, infinite, as we use the infinite bond issued by the government for the risk-free rate calculation. We can play on the structure, zero coupon, infinite, equal annual repayment, equal annual payment. We can also add cap, we can add floors, have complex formula to find the interest rate when it is variable or flexible. So we have many ways to define products which are in the family of debts, but which are not classical debt and bring some more elements in terms of cost and in terms of risk. And there is another category. And there is another category which is debt at the beginning. But for part of it can become part of equity later. And here we have two categories of products. The first one being the convertible bonds. When you issue a convertible bond, what is it? A convertible bond? A convertible bond is a bond is a debt, plus at least one option, at least a call. But you can have more complex convertible bond with several options, several calls, but also put which allow the issuer to buy back the issue, the convertible bond. So the basis is a debt, but it is a debt that in case of conversion of exchange at the end can become a share, and anyway, during its life, it is a bond, it is a debt, classical straight debt in general, plus at least one option and sometimes several options, at least a call, but you can have several calls, and you can have also puts in the hands which allow the issuer to buy back or to eliminate, to cancel, if you prefer, the issue. And this brings at the same time flexibility in the management. And remember also, and we'll come back to that point later, flexibility as a value, as a liquidity, as a positive value. It brings flexibility in the financial management. It offers also a tool to manage dilution of wealth and dilution of control. And there is also, you have looked at convertible bonds in terms of cost for the issuer under certain condition, at least, a reduction in the cost due to the fact that in valuation, the options have to be taken into account. And in the same family, debt plus option, we have another financial resource, which is the leasing. Leasing contracts are basically, debt plus option. And when I say options, in fact, you will say several options. Why we say several options? Because when a firm asks for a leasing contract to its bank or to a leasing company, which is generally a subsidiary of its bank, it means the firm is looking for, in fact, a debt contract which amount is equal to 100% of the value of the asset which is bought. But it's not only a debt contract. It is a debt contract plus options. So what kind of option do we have? At least we have a call which is in the hands of the user of the asset, and which allows him, when all the rents are paid, it means at the end of the leasing contract, to buy the asset which is behind, which is below, for a residual value. Second, there is also an option in the hands of the leasing company, which allows the company, to obtain back the asset if the rents are not paid regularly. So this option which allows the lender to take back and even to sell or to rent again the asset which is below, it's an option which has a positive value because it reduces the risk of a lender. And in many contracts, you have also more options which allow, for example, the company which uses the leasing contract to finance its investments to make a swap of assets after 3 or 4 years, for example, for cars or lorries, for a new one, which means, the options here are the tool to manage the fact that the relation between the lender, the leasing company, and the company which is using and belonging in the end, the assets are constant, are recurrent. So it's also in the category of debt plus options. So that means if you make, a small summary of what I'm trying to say, you have on one side ordinary shares, on the other side straight bonds, and the most common basis is infinite bonds. And after that, you have 3 other categories. You have preferred shares. You have, I would say, complex debts with flexible rates, variable rates, cap, floors, for example, and so on. And in the middle, you have got a category which is debt plus options, and they are more and more common. And the 2 main elements we know and we use, not only for large companies, but it's more and more a market for small and medium-sized companies. They are convertible bonds and they are leasing contracts. And of course, all these instruments have impact on all the measures we use in finance, whatever it is. It could be dilutions, it could be debt equity ratio, it could be returns to the shareholder, it could be flexibility, and so on. That means it's not neutral in terms of valuation. It's not neutral at all. And the higher the percentage of non-classical resources, it means ordinary shares and straight bonds is used, the most important consequences you find in the valuation calculation and in the determination of prices for operation. So that was the introduction here. And few words on leasing contract. So it's a debt contract, point 1, with a few specificities. The asset which is behind is 100% finance. Point 3, the ownership of the assets belongs to the leasing company up to the payment of 100% of rents. So one of the guarantee is the ownership. If you are the user and use a leasing contract to finance the asset, you can become the owner only when all the rents, 100% of the rents, are paid. And at that time, you can use or not an option which is in the contract and which allow you, in that kind of situation when all the rents are paid, to buy the asset which is below for a residual value. This point is quite important, and this is point 5 here. The value of the option is fixed at the time of the signature of the contract or not. It is linked to the kind of legal organization of the country. And let's bring us back to another element you should know, in that in the world, we have 2 main large systems. The first one is code-based, and the second one is common law. And in Vietnam, you are more code-based than common law. Common law is mainly British and partly American. Code-based is Latin-based. France is clearly a code-based country, but Germany also, or all, let's say, all the continental European countries are code-based. And some countries it's very funny because you have two different organization or legal system. For example, Canada, if you go to Vancouver, it's common law, but if you are in Montreal, it's code-based, because in the west part it's British, more British, and in Quebec is it's French history, which is the basis of a legal system. So this is very important because on many points in finance, both system, code and common law, are not compatible. And here that's true. This is a very good example because the option for the option which can be used at the end of the contract when all the rents are paid have a price. In the code systems, the price should be fixed at the time you sign the original contract. In the common law system, it cannot be fixed. It has to be fixed at the time the option is used, exercised, taking into account the fair value of the asset at that time, which could be very different. So it means, for example, it's not possible to sign directly a leasing contract between France and England, or Germany and England. No? For this reason, what is considered as a leasing contract in Britain is not a leasing contract in continental Europe, and the opposite is true also. Another point is that leasing contracts were designed in the 50s of the last century. That's a kind of innovation you find. Each time it's difficult to finance investments. It can be difficult to finance investment because there is not enough debt or equity available, because the growth rate is very important and savings on the other side are quite limited, because the returns of the company is not high enough to bring the necessary 20 or 30% equity in the projects required in the projects of investment. So it was at the beginning designed in order to finance the investments needed in a period of growth after the Second World War. But as many innovation, it was first used to finance very classical investment. Transportation equipment is the main example. But progressively, these leasing contracts were extended to many other elements, different kinds of production assets, but also more recently to planes. If you have a look to how planes, the large airlines are financed today. Very often, it's one in normal times. It means before pandemic, of course. It's about 1/3 directly by the company using its own financial resources. It means its cash flows. 1/3, by debt contracts, and 1/3 by leasing contracts. signed with specific funds. We have 2, 3 in the world, the private planes, and they make proposal of leasing contracts to the airlines. So it has been used extensively for boats also, and also for software, which is a funny thing, because software are very often specific. They have very short term, because innovation is going quickly. So that means if company doesn't pay after 3 years, the fact the leasing company can take back the software and sell it to another company is no use, has no value. So that means here that the value of the option of the leasing companies to take back the asset is close to zero, in fact, which is not the case for classical transportation equipment, for example. So you have different level of risk, different views also, over different period of times and in different economic sectors. So that's what they are, but they are debt mainly. Now, you have another element here. And we have another element I want to underline here is preferred shares. At the beginning, I would say a preferred share is an ordinary share, but with some specificities. In basic classical financial analysis, where we have to calculate ratio, there is no room for something between the total equity and the long and medium term financial debt. That means convertible bonds and the largest part of the leasing contracts, what we call financial lease, are considered as elements belonging to these two categories. And preferred shares are considered as shares, are part of the total equity. And convertible bond and financial lease are part of the financial debt, long term and medium term. And we know that this simplified analysis has consequences on the debt equity calculations. And of course, at the end, also on the cost of debt, cost of equity, what can the value of the companies? There is a bias which is introduced here. Point 3, in most of the cases, the owner of preferred shares, receive the same dividends than the owner of ordinary shares. They have a fixed dividend, but they have something else. They have something else which is considered on the financial analysis and also on the legal point of view as an interest. It means you can have a share being the value of a share is at the time of the issue is 100 euros. Both has the same right to dividend each year through the decision of the shareholders at the annual meeting. But we have a surplus which is given to the owners of preferred shares, which could be 2% of the initial value, 100 euros, which is between 2 euros. That means the owner of an ordinary share would receive a dividend, which is proposed each year by the board to the annual meeting. And in the second case, the shareholders receive the same dividend plus 2 euros per share. So there is an increase in most of the cases for preferred shares owner in terms of return, in terms of cash. Okay. But you will say, okay, why do we do that? Okay. That means that there is a compensation somewhere. There is a trade-off. And the trade-off is mainly between this higher return and the right to vote. And they cannot choose the right to vote. Or another possibility to give them only one right to vote and 2 rights to vote to the ordinary shareholders. So you get ordinary shareholders with 2 rights to vote for 1 share, and preferred shares owners with 1 right to vote, plus the dividend as the ordinary shareholders, but also, in fact, something which is analyzed as an interest, 2% of the initial value of a share. It means that somehow, that's what I'm trying to explain at the beginning, these shareholders, they are somewhere between the ordinary shares owners and bondholders. We use very often that kind of shares, in order to increase the total equity level of companies which are either family-owned companies, and the family want to keep a large majority of the right to vote. But in compensation, they accept to, for those shareholders without right to vote or limited right to vote, they accept to compensate by higher dividend, but it's not completely dividend, it's a dividend plus something which is more similar to an interest. It's also used by state-owned companies. Some countries, it was the case in France at point in time, and Italy also. The state, understand that some companies are the kind of big companies you have, like in the electricity sector, energy sector in general, for example. They need more equity. But to invest in more equity in companies, even in state-owned companies, is not a priority for the state. They have other priorities, but they don't want, to lose the majority. So what they do, they issue preferred shares, and the state, the government, doesn't buy any preferred shares. That means you have the state as a shareholder, and for another part, the owner of preferred shares, but the majority, or even sometimes 100% of the rights of vote are still in the hand of the state. So it's one way to organize an increase in total equity without losing the control of the company. And of course, this has an influence on the values. So this is what I wanted to show you here. Now, at that point, you have again, a list of models, who we use in following cases and examples. multiple models, CRPM, capital asset pricing model, cash flow based, Gordon Shapiro based, leverage model, and another one which is coming here. I didn't say a word on that up to now, which is what we call the sum of the parts models. Let's see, what does it mean? I said a few words yesterday on groups of firms, and one of the main points of group of firms is that they are made of different companies, and these different companies can be very different in terms of economic sector, size, for example, markets, also structure, culture. How to find the value of a group? It's difficult to apply the classical models we know to consolidated accounts. We have to take into account the specificities of the different activities, operations, the different risk, the different growth rates, and so on. So the idea is to say, okay, if we invest, this group is invested in banking system, in textile, in steel industry, in pharmaceutical sector, we have better to make calculations in order to find values of each company, or at least of those companies belonging to the same sector. So we divide the group into parts and calculate the values of each part. But after that, what we need, it is the value of the group as a whole. So we have to make the sum of the parts, which seems to be very simple, but which is not so simple for two reasons, at least. The first one is that among the portfolio of methods we have, some of the methods are more adapted to one economic sector than another one. Some elements are very difficult to give a value to in some economic sectors. That's something we already said was on in the past, and we'll see later today. Pharmaceutical sector. We know that we have research, and that research is very central. But how to give a value to a research team, to research innovation? What of in a more classical sector like the food industry? What about the value of the brands? And I have a look to market research. You understand that more than 50% of the market value of the largest group in the food industry in the world is coming, through the valuation of the portfolio of brands. Brands is very central. We have to integrate that. But if you go back, to the steel industry, it's clear that the most important points are not the same. So we have to adapt models, and we have to go into more details on some parts of the operations, or in some of sales, some of investments, in specific models, specific economic sector. So we calculate the values, and the level of, I would say, homogeneous parts of the group of firms. And then we have to make a total, to make a sum. The only element which is very difficult to identify and after that take into account are the connection between the different subparts. It is, are they independent or not? That's the problem of independence on a statistical term. This is the problem we find in portfolio management. And if you go to Markowitz model, go back to the origins, you understand immediately that we have some problem with the correlations between the different investments which are integrated into the model. We haven't got the same problem. But anyway, some of the parts model is very well used in that kind of conglomerate model. It's also used in some other cases, and one of the cases is the pharmaceutical sector, because the pharmaceutical sector, it's an economic sector with a balance sheet which doesn't represent the real situation of a company because of its important investment into research, innovation, and also commercial team, which is not integrated into the balance sheet. But we are able to make calculations very often through products. All these large groups you hear now on the world scene with a pandemic like Pfizer, or Sanofi, or Moderna, or some others, they are producing and selling different kinds of products which have nearly their own life. They are kind of independent firm inside the group. And that means, their structure of cost, of time horizon are very different. So they are mainly made of what we call blockbusters. So one way to make a calculation of values is to divide the group into subparts which are made of blockbusters. There are 4 or 5 parts in phase 1, and after that you have marginal activity. You have to take into account also. So the sum of the parts models is adapted to that kind of economic sector. So this is one point I wanted to go further. It's not a classical element you find in the textbook, because in the textbook generally they explain all these problems at the level of one firm. But the economy today is not made mainly by a one-third system. Even medium-sized firms, very often, they have several legal structures. They are a bit at least diversified, and the head of the group is in a holding company. So these problems are raised also. So this is what I wanted to explain at that point before we move again to these calculations here. So 1 or 2 points again before we go back to this exercise. You received also I use question coming from the number 2021, November 2021 final exam, and I send you this exam, but I sent you again through Miss Lynn. I sent you another one, which is a September 2018. September 2018 exam. I don't know where it is somewhere. 2018 exam, so I sent you this one also. I wanted to show you. I'm completely lost in my slides. No, it's not this one. Oh. Anyway, let's come back to something I know how to manage. let's say I'm still here, and I hope you still have a slide here. About the most used model. What I said is I used also the other one, which is the September, which is a September 2018 exam. And I started yesterday with the first element of calculation of one exercise, which is the largest part of this exam, 6 points out of 20, 30 minutes, and cost of equity, dividends, leverage, and values. And we use the first questions, and this exercise is called Charles, if you prefer, Charles, as the American says, Charles Company, okay? And the calculation we went through yesterday on the cost of debt are based on that exercise. So I gave you the numbers and the calculation I tried to extend. But if you want to find the original version, it is in your September 2018 receipt exam. You receive this morning, part 6. That's what I wanted to say. And we went through question 1 yesterday. Remember, we had the discussion around the tax rate on the cost of debt. We had a discussion also on how to find the cost of equity. We had a discussion later on profitability or not profitability of a firm and the consequences on the preceding calculation, the differences. And we had several interesting conclusions, in terms of financial policy, saying, of course, with that kind of analysis, we show that cost of debt is always lower, when a firm is profitable and versus a firm which is not profitable, at least if the tax rate is not equal to 0. And we understood also that the cost of debt was lower when the tax rate is high than when the tax rate is close to 0. And that somehow, when the Minister of Finance or government decide to increase the tax rates on the net income, net earnings of the firms, that means it is an incentive to finance the firm using debt contract. And we know that at the same time, generally the authorities, the government says to the entrepreneur, you have better, for the future of the economy in the country to finance using your companies using equity. So they send two opposite messages, which are in contradiction with the other one, or in contradiction together. In terms of financial management and macro and micro management, this is a problem, but that's happened in many, many countries over time. So that was part of the discussion. We said a few words after that on lease contracts, and we introduced into the calculation the financial lease contracts, and we left on the other side. It means with an impact on the income statement of the operational lease. Okay, and then we went to the question number 3, which is a question on the payout ratio impact. And we were in a situation yesterday night with an increase of payout ratio from 20% to 30%, which means an increase in the dividend per share, in the total dividend paid to a shareholder, which means also a decrease in the retained earnings and a decrease in the increase of the total equity level. And we understood that, of course, when we do that, according to the Gordon-Shapiro model, if you increase the payout ratio of the dividend, you increase the value of the firm. But if you do that at the same time, you increase, of course, the total equity level, but not at the same level if you compare to a situation with a lower payout ratio. That means that the book value will not increase, at the same level with 30% payout ratio than with a 20% payout ratio. And we understand that there is a kind of contradiction between the two effects of this decision on the value based on the Gordon-Shapiro model and the value based on the book value calculation. And book value calculation can be transformed into market value using the market to book value ratio, which is one of the points which is raised in question 4 of this exercise, but also on my screen on the slide number 8 here in front of you. So the question now is that CFO, this is question 4 of the exercise, part 6, and this is what you find in terms of calculation on your screen. The CFO also knows that the market value to book value ratio, you remember that market value to book value ratio, we met this concept very often in the past, and we know that when the market value to book value ratio is high, and at least higher than 1, that means that come back to your standard calculations, the discounted value of future expected cash flow for the firm is positive. Okay. His assistant forecasts a market value to book value ratio equal to 2.3 in 3 years from now. So you understand that we are moving from 1.8 to 2.3. What does this forecast mean for the total value of the company and the share value if in the meantime an equity issue for free parity 1 to 4 is proposed to the shareholder? So it's a more complex question. So you come back to a slide here, and to the first part of the question, we have a market to book value ratio, which is 1.8, and we will move to 2.3, 1.8 to 2.3. Okay. So, of course, this is point 2 here on your slide. The share price will follow the increase of the market to book value ratio. The share price with the market to book value ratio is equal to the earning per share, earning per share being 15, if I remember. 15. Yes, this is what we calculated yesterday. Multiplied by 9, which is in question 3. Remember that. So earning per share 15, price earning ratio 9. Calculation gives you 135. And now this was for a market to book value ratio equal to 1.8. That means if the market to book value ratio increases for one reason or another from 1.8 to 2.3, we will get now 135 multiplied by 2.3 and divided by 1.8. That means this is translated immediately into the price of a share and, of course, into the value of a company. And it's not anymore 135, it is 172.5 euros. So this is the impact of an increased market book value ratio on the value of a company. Now, if you take the second part of this question, what does this forecast mean for the total value of a company and the share value? In the meantime, an equity issue for free, variety 1 to 4, is proposed to a shareholder. What does it mean? It means that a shareholder with 4 shares will get 5 shares after the issues. He had 4 shares, he will get 5 shares. So if you are back in the first case, it means with the market to book value equal to 1.8, we get a price of 135 before the issue, 135 before the issue, and now a shareholder with 4 shares, a multiple of 4, get 5 shares, a multiple of 5. That means the new equilibrium price, come back to the calculation we made on equity issue, 135 multiplied by 4 and divided by 5, which is 108 euros. That's what you find here. If it happened after the increase of the market to book value from 1.8 to 2.3, we get 172.5, which is the new price after the increase of the market to book value ratio, multiplied again by 4 and divided by 5. It means again, the investor with 4 shares now has 5 shares, but there is no change in the value, at least according to the standard calculations. And he will have shares with a price of 138 euros each. That's what we find. Okay. That's where we are. So we have calculated here the impact, of an increase of the market to book value ratio, and we already know that. It's increasing from 1.8 to 2.3 here, but also the impact, according to the standard calculation, on the price of share, for an equity issue for free, with a parity of 1 to 4. You understand also, and this is point 4 on this slide, but again, the signal theory can explain a small increase of the total value and the price of a share after the issue higher than expected by the calculations. It probably means that if it is well managed, the process is well managed and explained, and we have good communication, to the market and to the shareholder, at the end of the process, we will have a small increase, and the price of a share and the value of the company will increase more than expected in the calculations. This is what we find. This was for question 4 of the charts company exercise, and we are here on slide number 8. Now you have another slide here, and the other slide here is on the next question of the charts exercise, which is question 4. You can, of course, make the calculation, but the most important point here is to understand what's happened. One of the hypotheses of the financial manager is the average cost of debt will increase by 10% in the medium and long term, and the average PER of the market will decrease to 7. So we increase the cost of debt by about 10% in the long run, and the price on the market, ratio of the market, will decrease from 9, what we have in question 3, to something which is lower, which is 7. Okay. What could be the consequences of this new financial market situation? What's happened next? So let's have a look to the slide here. Point 1, one of the hypotheses of the CFO is that the average cost of debt will increase in the medium term, and this is the same words. Point 2, the increase of the average cost of debt means a decrease of the net earnings and of the earnings per share. When you have an increase in interest paid, you have a decrease in net earnings in operational things. And at the same time, you have an increase in the earnings per share. And we know that according to the simple model, the price of a share and at the end the value of the company is a function of the earnings per share and of the price earning ratio. It means as P is equal to the earnings per share multiplied by the PE. If you decrease the earnings per share and you decrease the PE, of course, there's 2 reasons. Two models agree, 2 approaches, 2 calculations agree on the fact that the price and the value of the company will decrease, and we can calculate the new price of a share and the new value of the company, taking into account these 2 evolutions: the increase in the cost of debt, which has for consequence the decrease in the net earnings, and on the other side, the decrease of the price earning, which has also which act as a multiplier of the first effect. It is said also in point 3, even at the same time we have a decrease in the price earning ratio, a second modification will increase the decrease. It's a multiplier in the price of a share. Let's have a look to point 4. What do we say in point 4? Point 4 says, we will not find the same charges using the Gordon-Shapiro formula. If the dividend level the first year and the long-term growth rate are not modified. It means, we had an increase in the cost of debt, which is mechanically also a decrease in the net earnings and the net earnings per share. The hypothesis here is that because of the classical relations between the interest rates and the level of the stock market, the PE will decrease when the cost of debt will increase. And we make the calculations and we are able to say that, of course, the price of a share and value of a company will decrease, and there is a multiplier effect between the earnings per share decrease and the price earning decrease. Now, if we have a look to the Gordon-Shapiro model is based on dividends. Dividend discounted, not taking into account the cost of debt, which is not the WACC, but taking into account only the cost of equity. There's no reason why, in the short term at least, the cost of equity move. The only argument could be cost of equity is nothing else than the cost of debt plus business premium and financial premium. This is the only connection. And in that case, of course, the discounted dividends will decrease and the price will decrease. But here it seems that among the hypotheses, there is nothing on any kind of charge, on the dividend level and on the expected growth rate of the dividends in a long period of time. It means there is no charge in the dividend policy. But the question now, perhaps this is feasible in the short term. But is it feasible in the long run if you have a substantial increase in the cost of debt and that this new level of the cost of debt will be recurrent for several years? And in that case, probably not, because there will be an impact also on the cost of equity. It means the cost of equity, which is required by the shareholders, will increase, taking into account with business premium and with the financial premiums, the new level of the cost of debt. So actually, it's in the short term, no charge, no impact. In the short term, there is a contradiction between what you calculate using the simple model and what you calculate using the Gordon-Shapiro model. Probably in the medium and long term, the Gordon-Shapiro model will adapt through an increase in the cost of equity, which will decrease, of course, the value of P, of the price of a share and the value of a company. So that means that when you have looked to different approaches or different models, in the long run, they converge. But in the short term, and we don't know exactly what is short term, several months, several 1, 2 years, something like that, probably, we can have a quite important difference in the calculations, taking into account a new financial environment. And this is what I wanted to show you here with this question 4. This is what I wanted to show you here. Now, it's just for you, it's 9, for me, it's 4. Let's have a short break, please. And we come back, in a few minutes, with the following slide, which is slide number 10, and we'll discuss on Gordon-Shapiro applications. Thank you. Okay. So I hope you still see my slides. This is slide number 10 here now. Okay. So if you don't see the slide, just raise a question. And this slide is an application of Gordon-Shapiro model, in fact, And it is here, if you go back to your exercise, to the Charles exercise, question 5, you understand that the financial manager asks you to estimate the implicit growth rate of the dividends. That means the long-term growth rate. It's called in the literature implicit growth rate or long-term growth rate or long-term growth rate trend sometime. In the long run, with the above cases and discuss, of course, your results. This is summarized in point 1 here on the slide. So we use the formula after convergence here. It means we make implicitly, we make the hypothesis that K minus G is positive. It means that K, the cost of equity, is higher. There's less long-term growth rate, less trend in growth of the dividend here. So let's start again with one of the calculation, one of the hypotheses here, which is, if you remember, it was one of the preceding question. It was in question 3, and we had the first payout ratio of 0.2, second payout ratio of 0.3, and taking into account the data which are given in the case and also our calculations, we find that the price, which is obtained here in the first case, is 135 with a dividend equal to 3, and of course we K minus G divided by K minus G. So K is supposed to be known because we calculated K in one of the preceding questions yesterday. We take 1583, which was calculated yesterday, and we have 3 divided by 1583 minus G. So we know the price, we know the dividend of 3 euros. We had the calculation of the cost of equity of 1583, okay, and we are with this formula able to calculate G. That means we use the model in order not to calculate the value and the price of a share were calculated before, the dividend is known. The cost of equity has been calculated, and we make the last calculation using the formula with the convergence format in order to calculate the long-term growth rate of the dividends. So you get here, after making the calculation, it is on the same line, 0.3, the value of G, which is 15.83 minus 2.22%, which is equal to 13.61. That means, G is the long-term growth rate of the dividends, as it can be calculated using the data we get. This is also the slope of a line of regression. This is what we can find. What's after in the other case? Second case here is that we have a payout ratio which is equal to 0.3, and we know what are the results. we have 135, which is equal to 4.5 divided by k minus g. It means 4.5 for the dividend instead of 3. Divided still the same 1583. We made the calculations and we find the value of g, which is equal to 12.5. If you think to the results, and compare the results for the same firm, the set potential of return on the portfolio of investments, it is clear that if you start with a higher dividend the first year, in the long run, the slope of a regression line will be lower. Because in any case, you will have a long-term convergence result. That means to reach the same point in the long term, if you start from an upper point, the slope of the regression line will be lower. That's what you find here. So the difference is not so important, it's 12.5 in one case and 13.61 in the second one. So this result, which is quite important, out of the calculation, is underlined here in 0.5. The explanation is simple. If we start with a higher value for the first dividend, the growth rate in the long run, because the slope of the regression line will be lower. This is what you can find. This is a good example, of calculation using the Gordon-Shapiro model, not to find the value, not to find the price of a share, not to find the dividend, and not even the cost of equity. All these elements were already calculated by other ways, by other models, but we use it to calculate G, which is the long-term growth rate of the dividends. You can also try to validate your calculation because we find the value of G using the model as it is here. But you can also do the other calculations. It means the regression itself. You can start with your dividend, past dividend, future expected dividends, go into the regression process, find the characteristics equation of the straight line, calculate the distance from the different points to the straight line, have an analysis of variance, say a few words of quality of your calculations and results, and compare these results to those you obtain from the approach I present here on the slide. And you can do that. You will see probably that you have at least small differences because the two methods are not based on the same hypothesis. But of course, it should not be very too large. If it is too large, there is a mistake somewhere. Okay. So this is for the evaluation. Here, this is what I wanted to show you on this application. So in that presentation, you get also some elements on the leverage formula and a few questions. I don't want to go into the leverage formula right now. I want to keep it because it's a bit more complex. This is here, okay. But I want to say a few words on a few exam questions, which are classical exam questions. And those we didn't go through before, I will not use all of them. We have 6 questions on the 2 slides here. On that slide, which is slide number 14, okay? let's come back a minute, on the question number one, which is a very interesting question. The cost of equity can be calculated using the capital set pricing model and or the Golden Shapiro model. Explain comments and discuss the quality of the results obtained. It is clear that the left side of the formula, the capital set pricing model, is supposed to give you, a proxy of the cost of equity. Okay, but it is based on calculation, integrating the risk-free rate, the expected return of a market, and the beta. Okay, and if you try to explain all these elements, the risk-free rate is generally a spot rate. It is the government 10-year maturity infinite bond interest rate this morning. The expected return of a market is calculated, is obtained through local analysis of the future markets positions on the largest index of the stock market. It means if you are in the US, you take the Standard & Poor's 500 and have a look to the 3 months or 6 months future value of this index. So one is spot, one is future. And for the beta, how do you calculate the beta? You calculate the beta using, the past references, generally in the last 3 months, and for each day, you take the price of a share, and you have a look to the value of the index. That's your basis of your calculation. And after that, you calculate, what is the changes in the price of a share when the value of index moved by 1% up or 1% down. But this is based on an average of past data. And you can also discuss, and have a discussion with literature, how to use this data. Do we have to weight the numbers, taking into account the volumes traded every day or not? Or an arithmetic average is sufficient. So anyway, you have 3 different categories of data if you take into account time. Future data, spot data, past data. If you have a look to the Golden Shapiro model and the calculation of the cost of equity, you take into account the dividend. The dividend is nearly a spot data. It is the first dividend to be paid. Second, you use, of course, the price of a share, and if company is listed, at least you get day-to-day information. So it means it's a spot data also. And you have this factor, which is the long-term growth rate of a dividend. And in regression, generally, we mix past data, present data, and future data. We have also here a problem of homogeneity. But the problem of homogeneity are not exactly the same in both models, if you consider time, at least origin of the data. Another point also is, of course, the fact we use indexes, which are easy to use in some cases when you have large stock market, but in many countries, it's difficult to have something which is acceptable, feasible in terms of future position on future markets for the largest stock index. So you have a difficulty here, but the difficulty exists for the expected return of the market in the capital asset pricing model mainly, but you find it also partly for the long-term growth rate of the dividend. So we have anyway for both models a mixture of data which are not comparable. The weaknesses are not exactly the same, but in both cases we have in fact proxies, and the quality of the two models is limited. It's difficult to say that one model is better than the other one, but we have to be very careful in using these models. So, in your answer, underline the strengths and weaknesses of the capital asset pricing model, same for Gordon Shapiro model, and conclude as I did. This was the first element I wanted to go for. Question 2 here. It's a very classical question. I think I already said a few words about that in the past. The calculation of the weighted cost of capital should integrate the cost of short-term financial debts and the average cost of leasing contracts. Explain and discuss. So be very careful of what you do. I mean, the problem of calculation of the cost of capital is not exactly the problem of calculation of a debt equity ratio. You are not looking for a kind of element of answer to the same question. When we deal with the debt equity ratio, at least in the classical formula, we use only for debt and financial debts, and it is financial debts medium and long term. We are making an analysis of the relation between the percentage of debt, financial debt, and total equity for long and medium-term financial resource. The hypothesis here is that short-term financial debt or operational debt belongs to another kind of analysis. So, but in that case, you should of course take into account all the total equity element and all the classical element of medium and long-term debt, whatever they are: ordinary shares, preferred shares, convertible bonds, leasing contracts, at least if they are financial lease contracts. For the weighted average cost of capital, as you probably noticed in the Charles exercise first question, we take into account all the financial resources, whatever they are, not the operational resources. It means you never integrate, of course, the debt to the providers, to the tax system, to the workers, but only those due to the markets, to the banks. And that means if you come back to the details, you take into account all the categories of total equity, all the categories of financial debts, short, medium, and long, all these intermediates, financial resources like convertible bonds and financial lease, not operational lease, financial lease, but also the short-term financial debts. And this was in our calculation yesterday, if you remember. And that's the difference between both cases. This is what we find as a difference. Now, we went through already question 3 and question 4, so I don't want to go again into that kind of detail. But here there is an interesting new question, which is question 1 on slide number 15. Question 1, slide number 15. And what do you find there? Following question. Some approaches used to estimate the value of a firm in a privatization process or an equitization, as you said in Vietnam, are based on multiples of EBITDA and or EBIT and earning per share issued from benchmarks coming from other listed companies located in different countries. Explain and discuss how to use this data and to choose the final price. This is a difficult question, but this is a useful question to think to. We said when we use comparables benchmark, we use also in an approach, a valuation approach, which is based, on ratios, on multiples of EBITDA, EBIT, and earning per share. Which are very classical. And if we use foreign references, is that because you don't find good references, good comparables in the country of a firm which is analyzed. And this happens more and more. Even in large countries with large stock markets, we have so many niche, in fact, that it's difficult. It's difficult to find a good benchmark. And very often the best benchmarks, are not in the same country, they are in other countries. But the difficulty there is that this benchmark or these comparables, these benchmarks, are located in different countries with different backgrounds, historical backgrounds, different saving rates, different legal environment, bank environment, and so on. And that means if you consider, for example, the reference, which is the stock market, you understand that the stock market level is not the same. And one way we use to adapt, the multiples we find on benchmarks located in different countries is to correct them using the relations between the two index. If a market, for example, let's say, just an hypothesis, you are in Vietnam and you estimate that today the PE of the Vietnamese markets, I should know, I don't know, it's 16, and that, for example, the PE of the Singapore market is 18. That means if you take a reference which is in Singapore, you should correct this reference to translate it in Vietnamese terms by the relation between the average PE of both markets. It means 16 divided by 18. You calculate, for example, the multiple of EBITDA of the benchmark you find in Singapore, and you multiply it by 16 and divide it by 18 to take into account, let's say, the local dimensions. The same for other multiples ratios you find using EBIT or earning per share. So after that, Johnny, what we do, if you find the first benchmark in Singapore and you use multiple of EBITDA calculated on the last 3 years, now your n and -1 and -2, you make the average, you have an average, and then you multiply by the relations between the P of both markets. Sometimes you have 3 references and 3 benchmarks, and 3 benchmarks are located in 3 different countries. You do the same, making the same analysis. So this is one way to integrate a kind of first, correction, modifications, taking into account the differences into the structural environment of the markets and valuation process in the different countries which are in your comparison. So these are a few questions I wanted to go through with you. Now, I hope I will succeed in doing that. What I want to do is to show you something else. And it is here. And I hope that you see these new slides. Yeah. Consolidation in the European pharmaceutical industry. Do you see this slide? If you don't, just say, I don't see the slide. I hope you see the slide. Okay. It's another story, but it's a good application of what we did today. It is a case of M&A, of acquisition followed by merger. And I will come back anyway on that case, which is a very important and very good example in the pharmaceutical sector in the M&A course. However, I want just to show you here a few elements. A few elements. We have to, just in a few, you will see the slide and I will give you in the M&A part more detailed elements and more detailed slides. Sanofi, in January, you know Sanofi in Vietnam. It's one of the largest pharmaceutical firms in the world today. And this is a group which is French-based. And at the time of the offer here, in the middle of the first 10 years of the century, Sanofi, which has grown mainly by acquisition, was the number 2 in France after another partner, another player called Aventis. So it means it's something which happens sometimes. It's the number 2 trying to buy the number 1. As we say in finance, the small fish trying to buy the big fish. And this dimension is quite of interest, but this is not what I want to concentrate on today. What I want to show you is that we are, in the pharmaceutical sector, and we have specific problem of valuation. And to do that, we had several approaches. And some others could not be used. The first one, which cannot be used for a reason I already explained, are those based on the balance sheet. So we could not use, for example, the value after modifications, adaptations, or the equity level multiplied, for example, by the market to book value ratio. We had too many bias there. Because when we think to what is the value of a kind of large economic player, it's in large part, it's based on the quality of the research teams, level of innovation, good choice in research programs, but also in the quality of the commercial teams and in the fact that their level of sale is made of, for a large percentage, of blockbuster sales with dominant position on their specific market. It means capacity to increase the price and the margin. And this is not taken into account at all in the balance sheet. So there is no way to do that. Second, we can, of course, calculate the value of the share using the market capitalization, market value in total using the stock market. And we can make parity, calculate a parity between the two shares. This is what you find here. Now, we have another point, which is on the synergies. And they calculated very carefully, they identified and calculated very carefully the synergies. And they tried to do two things. One is to make a schedule, how long to obtain these synergies, positive, negative, cost and sales. And second one, they were very cautious and they compared to what they expected to the synergies obtained, not calculated, obtained after acquisition and merger by preceding buyer in very recent acquisitions. And you see, to do that, after the calculation, this is on this small table, slide number 17 here, we compared the level of potential synergies to the level of sales to those obtained by Pfizer in a recent acquisition and those obtained by Glaxo in our recent acquisition. And they concluded that their expectations were substantially lower, and that probably they were feasible. That's how they did. Now, just before you had a slide which shows a process which can be used. Determine the synergies, what we did, slide 17. Make assumption and design the table to calculate the free cash flows and then find an appropriate discount rate. Now, it is clear that on the other side, they were also able to calculate multiples and to find values using multiples of EBITDA, multiples of EBIT, multiples of net earnings, because in that economic sector, we have averages can be calculated through the data available on other large companies listed on the stock markets. So here, this is the way through free cash flows calculations. And through free cash flows calculation, you know how to calculate the free cash flow. This is what we do together in the last course. and they applied this method of calculation of the free cash flows. Okay, and you have a table. If you are interested in these tables, you can go into this table. This is one way to understand clearly how to do that. And it is on a 10-year. It is a 10-year process. And we had the free cash flows, free cash flow simulation, free cash flows forecast on a 10-year horizon. And you can go to all the lines here and try to understand what are the growth rate, and the growth rates are also calculated here, taking into account the potential evolutions of the markets and of innovation. This is one of the most interesting tables we can find. And this is what you have to do when you go through that kind of process, But you understand that it is very, very difficult. Of course, it's less difficult when you are the number one in the market, because you have an impact on how the price are fixed, which is not the case when you are number 6 or number 7. You have to find your way into a market which is structured by the number 1 and the number 2. Now, and this was the second point, if you remember on that preceding slide, you make assumptions about the calculation of the cash flows, you make the calculation of the cash flows, you integrate the synergies, and you find an appropriate discount rate. Okay, an appropriate discount rate means you need a cost of equity. Cost of equity, it is clearly the application of the capital asset pricing model. Risk-free rate is not so difficult to find. Remember our technology case. Expected return of the markets minus the risk-free rate, not too difficult. Expected return of the market is calculated through future of the future contracts of the main stock index. Beta calculated, as we mentioned, and using part data. Okay, and the results here, the formula is clearly the cost of equity. Classical, very classical application of the capital asset pricing model. Okay. Now we have the information on the debt equity ratio. We know the cost of equity. We know the cost of debt, which can be easily calculated in biotechnology also. You have the impact of the tax rate, and you get the WACC. So we have the possibility to calculate the WACC. And then, and this is the most one of the most interesting parts of that kind of presentation, you have the calculation of what we call the terminal value. You get the formula of terminal value and the elements of calculation, and we obtain at the end the share price. So it's a share price obtained using the free cash flow calculation. You integrate the synergies, you have a format of the free cash flow calculation, you have a hypothesis of growth or decrease for each line of the table, make the calculation, get the free cash flows, calculate the cost of equity using the capital asset pricing margin, then the weighted average cost of capital, and of course, you need, after 10 years, terminal value, which has to be calculated and integrated into the flow, future flows, present value of free cash flows, and you get the price of a share. So now you have a table here. We were here with 65.99, and you get another table. And what is this? What is this table? This table, is a table including simulation on the main elements, the more sensitive elements of the calculations. And it means first on the discount rate. So of course we made calculation of the discount rate, and here, no, it's not here, it's on the other side. We made calculation in order to find the discount rate, 6.36%. But you know, this is based on elements which are known at the present time. We don't know what will happen in the future. We are with this value into the calculation, and we have admitted also in the terminal value a rate of infinite growth of the future cash flows. Okay. So if you take into account the rate of the future cash flows and the discount rate used in the calculation, it means the WACC, yeah. And you move slowly from the value you have calculated with strong hypothesis, the different calculations, you understand that the value of shares you obtain is moving, is really moving. It's not marginal. You start here, remember, with something which is close to what is it? 66. 66. 66 is here in the central part, and it is with 636 and 150. Infinite growth for cash flow is 150. 626 for discount rate of WACC. Now, if you move slowly with data, what's happened? It means you come back on your calculations, moving these two data. And you understand that if you decrease the discount rate, you increase substantially the value of share. 66, 73, 83. On the other side, 59, 54. And the differences are not so large. 636, 686.5, 586.5. You move from 0.5 on one side, it's 59. On the other side, it's 73. If at the same time, you have here a decrease from 150 to 125 in the infinite growth rate, you understand that 66 is not anymore 73, but 70. Or if it is 175, it's 77. So the final result is very sensitive to the marginal modifications of the discount rate and the rate of infinite growth. So we know that we have a central value, but we understand also that some of us are also feasible, taking into account the fact we have integrated uncertain data, make proxies in the calculations. And what was decided to do is to eliminate all the data which are in color, and to keep only the central part in white, and to say, okay, how can we move here? What is the price range? What is the price range? And you see that the extreme points here are 1761 here, 77 and 57. And we are able to define ranges. Okay, to define the range. And this is what was done. Okay. So you know what the synergies, excuse me, are part of your capacity to negotiate. You know also that some of the prices are quite close, but different from your central expectation are feasible and can be eventually accepted during the negotiation. So this is what's happened. At the end, at the end, it was agreed that the price after the, no, it's not here, but the final price will be, somewhere in my slide, I don't remember where, 68.11, which is not so far from the central hypothesis. But that means that inside this range, which have been found, which are the numbers in white in the middle, the negotiation took place. Here was better of the market, hostile offer, and then the negotiation. And after the negotiation, they agreed on 68.11. This is the final price. All the others are values, even if there is a central value. Yeah, okay. So it was a bit more complicated, and I will come back on that later. But what I wanted you to understand is that you can easily find the parity, easily find multiples and benchmarks. We can allow us to find the value using the EBITDA, the EBIT, and the net earnings ratios. We are able to find something which is acceptable in terms of valuation of the synergies. We go after that through the free cash flow process, cost of equity, WACC calculation, discount rate of the free cash flow, and have a sensitivity analysis. All this is easy to do. There is no way on the book value side and multiple because of the difficulties of taking into account of different strategic items like innovation, cognitive research, and blockbuster dominance of the market. But there is also another possibility, and the calculation is not here, but we'll go through later in the other course. It is to say, what is Sanofi? What is Aventis? They are not very unified firms, but both of them, are made of 4 to 6 blockbusters plus a marginal business. So perhaps we have better to use the sum of the parts method. It means to calculate the value of each blockbuster and then take into account eventually the different correlations and add the terminal value for all the other businesses and services and products which are sold by the company. So this has been done also, okay? But at the end, one thing which is of interest is that if you compare all the data obtained, the final price is closer to the free cash flow calculation than to any other. It is as if in the negotiations, both parties were coming back to this basis of the financial theory, which is at the end, only the free cash flows in the long run are important. All the others are kind of proxies, but nothing else. So this is probably the lesson on that case. So this is what I wanted to show you today. I went through quick summary of what we did last time and what I wanted to do today. Then a few questions coming from exam, final exam November 2021. And for 5 questions there. Went then to a few points on biotechnology, and we'll go further in the next session. We went into some kind of complex situation on the pre-purchase and leasing contracts. The bank on the charts exercise with more questions than we did before, like means yesterday. Market value to book value, cost of debts, and price earning impact, Gordon Shapiro model. We'll have the leverage formula and the consequences of the leverage formula for next time. We had again a few questions on the other exam, the recent exam from 2018, and I wanted just to present you today a few points of application of valuation methods on a large acquisition in the pharmaceutical sector, followed by a merger, anyway, which showed the different use, different importance also of different valuation methods, and the fact that at the end, there was a kind of convergence after negotiation to a price which is close to the central value obtained at the end of the simulation using the free cash flow method, which is completely in line with what, remember, Olivier Grossin said in his course on investment decision. Okay, so I think that's all for today. This was the end of session 2, and we will meet again, but tomorrow evening for you, tomorrow afternoon for me, for session number 3. Thank you very much, and goodbye, and see you tomorrow, and have a good night, and sleep well, and take care anyway. Goodbye. Okay, no question, nothing else. Okay, goodbye.